Good morning, this is Steffi and welcome back to the Financial Fox, investing and innovation ideas with a twist. Before I go into the topic today and I introduce you my guest, I would like to thank you all our subscribers for supporting the channel, liking and sharing the content is so much appreciated and I give all of you a big kiss. So, what we are going to be talking about today. Today, we will discuss investing strategies, risk and opportunities when investing in startups, angel investors, alternative investment and favorite sectors, but we will also talk about tax relief strategies and public markets. My guest today is Tom Britton, co-founder of Syndicate Room, a data-driven EIS fund that invests into 50 plus promising startups per year alongside the UK's top performing angels. So I'm really excited to talk to Tom and see what they are doing at Syndicate Room. So let me connect with him. Hi, Tom. How are you?
Hello, Steph. I'm doing all right. Thank you. How about yourself?
Oh, I'm fine. Just all right.
I'm good. The weather's nice. It's changed. It's spring. Can't complain.
Exactly. So anyway, Tom, you are the co-founder of Syndicate Room, but you are also an ex-professional footballer. How that came that you actually end up in the financial world?
Yeah, long story. I'll try and keep it quick. I mean, with the football, I grew up in Los Angeles. My dad was Scottish, so we always grew up playing football, soccer, as they call it in the States. And when I got done with my undergraduate studies, I decided to move abroad to test myself, really, to see how good I actually was. So I moved to Scotland, and I ended up playing in the lower leagues in Scotland. So I started with a team called Berwick Rangers, who won the 3rd division, got promoted, which was great. I got a league winners medal. The next year, they got relegated. So the opposite experience, although by that time I wasn't with them anymore. I'd moved to another team, but played for a few years in the leagues and had always been interested in technology. And when you're playing in the lower leagues, you're not really making a huge amount of money. You do it because you like it. You get a little bit of cash, but eventually I realized I wasn't going to make it to the top. So I kind of fell back on my interest in technology and joined a company called trainline.com, the mobile apps and train website, and really kind of loved what I did there in product management. And I think this was back in 2011, 2012, they was talking about selling the business. And it occurred to me that I'd been with them for a while, but I had never been offered stock options. It was just didn't come to me. I probably should have asked. And I felt at that point in time that it was probably right for me to go and start my own thing where I kind of had a vested interest in the company and I wasn't just working hard for somebody else. So I went to Cambridge. I did my MBA because being American, I thought, got to get an MBA if you're going to start a business, which definitely isn't true. Not that it wasn't a good experience. It was just, most of the lessons I've learned have been from doing as opposed to sitting in a classroom. And while I was at Cambridge, I met Gonzalo, who was the co-founder of Syndicate Room, who kind of had this idea for what the initial version of Syndicate Room was, which was a platform for people to come and co-invest with business angels. So I didn't really have a huge plan, to be honest. I was kind of following my passions, if you will. And it ultimately led me to meeting Gonzalo, who had this idea that I thought was great. And 8 years later, the business is still here, even though it's changed in many ways, but we're still going strong. So.
Okay, Tom, so let's talk about Syndicate Room, which, as you said, has evolved over time, started as a platform and now is a data-driven EIS fund, which is also quite unique. So maybe do you want to explain, the evolution from the initial concept through the decision to shift away from a platform and focus on a fund?
Yeah, happy to explain. So the initial concept, I guess actually our core ethos has been the same. It's to let a wider group of individuals co-invest into opportunities alongside angels. how that came about in practice initially was a platform. And the platform was structured similar to a crowdfunding platform, where people could pick and choose investments they wanted to go into. But our USP at the start was all of the opportunities that we let people invest in they were co-investing with angels who were leading the round. So there was a bit more structure and due diligence being done by these angels before it came to the platform and then went out to our investors. And that concept worked really well at the start when crowdfunding had a momentum behind it. It was kind of the interesting new player in fintech or alternative finance. And we got good traction early on. But over time, what we learned was that the mechanics for a crowdfunding platform aren't appealing to both companies and in many ways investors. So on the company side, if you want to do a crowdfunding round, there's a lot of time and preparation that go into getting it ready. You're spending a lot of effort putting together the right material, creating videos, getting the wording just right for this campaign. Then it has to be approved by the platform. Once it's approved by the platform, which takes time, you then have this window of say 4 to 8 weeks, and in some cases 12 weeks, where you're doing the fundraise online. And it's a bit of a grind. You're answering questions, you're hosting webinars, you're trying to drive people to this website. And then at the end of it, you've got this closure period where you then have to get all the capital in, send out all the documents and certificates. And from start to finish, it could be kind of 4 months if everything goes smoothly, or it could be 8, 9, 10 months if things don't go so smoothly. And what we found was that a lot of the companies that were kind of being fought after by angels had no desire to go on a platform, to spend a huge amount of time raising, particularly when there was this public element to it. So if they weren't raising a lot, actually they got left with this stigma of like, you didn't have a good raise and it was in this public environment. So more and more we were seeing these companies that we wanted to work with turning us down. Clearly, if those are the companies that go on to do well, the returns that investors would get would start to come down because we weren't getting those best opportunities. And in that sense, it was harming the investors on the investor side because they weren't actually getting the access to the deals that we wanted to get into. So we were getting this in and we started to look at like, okay, well, what can we do to optimize the platform? We spent some time trying to make it more efficient, but ultimately realized we couldn't get it to a point where both sides of the platform were happy. And so we decided to take a decision to wind the platform down and spool up this fund that we had been building in the background, not really marketing too much, but letting people who wanted access to startups but didn't want to pick and choose, they could come to a fund and then we would create a portfolio for them. And so when we were winding the platform down, we said, look, we're going to pivot. We're just going to be this fund. And so, gosh, the process started about 3 years ago in trying to figure out what this fund should look like and how it should work and how it would benefit both companies and investors and be different to what else was on the market. And we launched this fund, which took a while to gather all the data for, in November of 2019. We had a really strong launch period, which was great. And then obviously, the world changed. Saw a slowdown in the money coming into the fund for a period of time, but then kind of towards the end of last year, it was picking up again. And I'm delighted to share, if you will, that we had BBI, the British Business Investments, a part of the British Business Bank, actually committed 10 million into our fund for us to deploy over a 3-year period, which was kind of like, I would say, the culmination of 3 years of hard work and effort going into it. And then to achieve that and be able to say, look, like actually it was the right decision to pivot, meant a lot. So now we just operate this data-driven EIS fund, which seems to be doing all right.
Okay, Tom, but explain a little bit more in details why this fund is different from other funds out there.
Yeah, so if you were to look at kind of the early stage venture funds in the UK, and in particular the EIS funds, they're all fairly similar in structure and how they go about doing things. So a typical EIS fund will invest in, say, 8 to 12 companies. Some of the funds that talk about being more diverse might invest in 15. We invest in 50 per year, per annual cycle. Typically a fund is looking for, or an EIS fund is looking for companies with a bit more traction. So they're, I'll say, de-risked in some sense because they either have more revenue or they're further along in the development of their IP or trials if it's life science and biotech. What we do is we go in really early. We co-invest with these angels. And what gives us the the ability to go in earlier, or the strength of conviction to invest this early and build this diverse portfolio, is that we did spend about 2 years indexing the startup market in the UK. So looking at all of the fundraisers that have occurred going back to 2011, looking at how every company that's raised capital, equity capital, has progressed over time. Have they raised follow-on rounds at higher or lower valuations? Have they gone bust? Have they had an exit? And then we picked apart the cap tables to see which players, which angels, which VCs are investing in those companies. We looked at the size of the rounds, and we looked at a number of other metrics. And once we analyzed that and could see kind of the market, if you will, much like an ETF tracker fund, we looked for the managers, or in our case, the angels that were consistently beating that market. And we aligned ourselves to those angels. On the portfolio side, just coming back to that, why 50? Well, we ran Monte Carlo simulations over the market at the stage that we were investing. And what we found was that at 50, we get sufficient diversification that even if we're at the lower end of what we predict we'll be able to hit in terms of returns, we're still kind of beating the typical market level. So there was a lot that went into this, and a lot of other lessons just on how the market moves and fluctuates, the startup market. And so we've got quite a bit behind it and riding on that analysis.
Well, it looks like there is also a lot of data behind the decision, behind building the fund and also analyzing the market, which is quite interesting and quite unique as well.
Yeah, and I mean, some of that data, just to share, so if you could have invested in every private company that raised a seed round in 2011, a sizable seed round, there was something like 650 of them. If you had put $1,000 into all of those, the growth up until present you would have achieved would be 28% year on year, which goes far above most public funds. You would have seen about 19% year on year returned in cash. Now, obviously, it's a long-term holding, so it's not like every year you check the portfolio, it's up 28%. But looking back on that 10-year cycle, if you had held on to everything, which you would have because they're illiquid investments, you would have achieved that 28% year on year and the 19% in cash, which is quite nice, particularly as it does not include the EIS relief, which eligible investors can claim on their investment, which is pretty sizable.
Okay, maybe let's break down a little bit your fund strategy, because it's quite interesting what you said, the way that you actually select the companies. You probably have some very specific parameters and some specific angel investors that, you like to align with. Do you maybe would like to give us a kind of like a quick overview and the key point that, a startup need to have in order for you to consider an investment, and also how much money, what's the average investment that you put forward?
Yeah, no, happy to talk about that. So as I mentioned, like the market, if you invested in everything, would grow at 28% year on year. But what we found was there was a group of angels that beat that, and some of them quite heavily. So what we did was we found out these angels, we discovered them, we reached out to them, and we selected a group of them that we wanted to co-invest with. And so we have this network of angel investors who, to meet our criteria, they have to beat the market, so have seen 28% year-on-year growth for at least the last 5 years. They had to have at least kind of 1 5xer in their portfolio, so 5 times return in their portfolio. They have to be making consistent investments, i.e. they didn't just get lucky once, but they're doing at least one new investment per year. They can do follow-ons, that counts, that's great, but they're doing 1 new per year. So it wasn't like someone just invested in one thing, it did really well and they got lucky. We have to be able to analyze their portfolio and to determine if there is a pattern, so that when they bring a company to us to invest in, we can easily screen it to figure out if it does fit within their pattern and their typical style of investment. And by that, I mean, is it an industry that this angel typically invests in? Is it at the stage they typically invest in, the amount of round size that the angel would typically go into? Is the angel investing as much as they would typically invest? And in some cases, it's quite specific. So some angels are, I put 25 grand into every company and I don't change that. Some have a range of companies, which may depend on the stage of the company they're investing in or the size of the round. So we have to know all of this behavior, if you will, and understand whether or not this new investment that they're bringing to us matches that, so that we're comfortable going into that company. Now, we don't generally invest in very early small rounds. They're a little bit too risky for us. What we like to see is that the company is raising somewhere around £400,000 up to about 3 million. And that's the size that the data says for the risk to return trade-off that we're looking for with this fund is about right. Anything below that and the risk level is just a little bit too high. Anything above that, it doesn't mean it's a bad investment, but because of the size of check that we're writing, if it's too late stage, the potential multiple on the return is lower than what we need for this specific fund. So 400K to 3 million EIS eligible companies with an angel that meets our criteria, investing in the typical behavior that they would invest. That's the main thing that we look for from an initial check. And then once that's done, we go into the normal legal due diligence, AML, KYC, founders, directors, et cetera, making sure that the terms of the deal are good and we're not going to get bit later on should something happen. And in most cases, when the angels are getting involved, they have pretty good terms already for the deal. So we just kind of piggyback off of those.
Wow, so that's actually, it showed the difference, because you are actually investing, is more from angel investor due diligence rather than doing the due diligence on the startup and then identify the opportunity. I think the perspective, you know, that your strategy has and your fund has is quite different, is quite unique, more following what is the success of successful angel investment rather than the opportunity or the potential that a startup could have, which you know, is usually probably the standard way to invest, is that fund look at the company and they make the decision, and then who has come along is not actually seen as a, you know, as the best friend or as the partner, where you are actually looking at the angel as your best friend and partner in order for them to bring the investment opportunity. Is quite an interesting way to see it, and it works.
I think that, I mean, the stage at which we go at with these companies, they often don't have a lot of traction. So these are, you know, very seed stage startups. They may not, a lot of them don't have revenue, or they'll be very early in their development of whatever they're doing. So there's not a lot on the number side or the financial side for us to make a decision at that point. You know, when a typical fund gets involved at the Series A level, okay, the company's been a little bit more developed, they've got some revenue coming in, they've got users signing up, they've got phase 1 trials done, whatever it might be. There's more to go off of that you can analyze in a traditional VC strategy way, and look through that and say, okay, well, do they still have the potential? Are they executing right? But at this stage, you just don't know from the numbers. You know, they're like, yes, 100% year-on-year growth. And you're like, okay, well, you've only been going for 1 year. You know, like, it's very early to have large growth percentage, even month on month when you're just starting out, because you're starting from zero. So these angels are very much a proxy for the strength of the company. And they seem to have this kind of knack for being able to determine if the founders in particular can actually deliver on the vision. And I think that's kind of the most important thing that the angels look for. Not I think, this is what they say. You know, we look for founders that we believe can actually deliver on what they say they will. And oftentimes they don't really look at the numbers as factual. Like at a startup stage, when someone comes to you and says, these are my 5-year forecasts, to be honest, most of it is, I'll use the phrase, just hogwash. Like you can't really predict where it's going to go in 5 years' time when you're just starting out. But what the angels want to see is, have you clearly thought through this and all the different factors that might impact how your growth is going to go, rather than what is that final number. And you know, that final number being big or not isn't as important as what the logic has been to get to that number, and an ability to understand what those different metrics and levers are that you need to pull to get to that metric. So it's more operational minded and trying to suss out, are they smart enough to think this through, as opposed to just throw something on the wall and run with it. And can they actually then deliver on that? Do they have what it takes to put up with the stress that running a startup entails?
Yeah, there is a lot about investing in people, so which is which is always, the key. But there will be some sectors they are growing of interest to the angel investor you co-invest with. Do you maybe want to break down on like the key sectors that you see are setting the trend and you are seeing there is more demand now and going forward?
Yeah. I mean, there's a few big ones. Health tech, life sciences, biotech are definitely growing rapidly. Accelerated by COVID and accelerated by the technologies being used to design and discover drugs and molecules for drugs. So we've seen a lot of companies coming through in the last 12 months that are working on machine learning and artificial intelligence to create new drugs and cures for various diseases, which I think is fantastic. If you had gone back 2 or 3 years, the number of angels investing in those things would have been restricted to those that had experience in that sector, whereas now it's of interest to pretty much all of the angels, and it's a booming sector. The size of the market is huge, so there's a lot of room for these startups to come in and be more agile than a large farm tech and come up with something cool in terms of the tech or actual drugs themselves. So that's one of them. Obviously, with people working from home and studying from home, ed tech has become a popular sector for angels to invest in. So we've seen a lot of things about online learning, different types of what do you call them? Multi-online courses, MOOCs. I always get the acronym wrong, but lots of different MOOC providers, companies that then help you optimize your course so that you're training it better, and diagnostics to understand if the students are actually learning from you, and long-term retention. It's not just about having a Zoom call and teaching it that way. It's about how do you measure that Zoom call that they actually learned and stuck with it. So a lot of apps and measurement tools for that in the edtech space, which is really cool. And just delivering education to a much larger audience, I think is definitely on there. There are a few other things. So, I mean, I know you discuss blockchain and crypto a fair bit elsewhere. We have started to see more blockchain companies coming in and using the application of blockchain for different things. So one of the companies we invested in is called Nuggets, which is all about personal identification. So using blockchain to be able to verify you are who you say you are, or clients are who they say they are, which is pretty cool. I mean, a few years ago, you say blockchain and everyone's like, oh, we wouldn't touch blockchain because of crypto and there's some taint to it. But now they're like, oh, there's actual uses for this that aren't just a cryptocurrency. So we're seeing a few more blockchains companies coming in, which is nice. And fintech remains hot. It's been hot for the last 6 or 7 years, but there's a lot more being done in fintech and different types of investing technologies. So we have a company called Ticker, which is lets you round up savings and then invest it in social impact companies. And not necessarily listed social impact companies. So they're kind of creating their own market where you can invest in these smaller social impact companies, which I think is great. And with the rise of ESG, as you know, and corporate responsibility, CSR, I think the whole green tech and social impact, I unfortunately lump them together a little bit. I don't intend to, but green tech and social impact investing is on the rise.
Yeah, indeed. But also, one of the advantages of investing in startup is also the tax relief they are available for qualifying investors. And I think this is something that, is quite appealing for many investors they are watching. Can you maybe talk us through those advantages and what are the benefits that qualifying investor can get out of investing in startup?
Yeah, absolutely. So just to be clear, like in the UK, there are two big tax reliefs on offer for investors who pay taxes in the UK. So you don't have to be necessarily British, but if you're working in the UK and paying taxes in the UK, then you can claim these reliefs as well. And they're called the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme. The Seed Enterprise Investment Scheme is focused on very early stage companies where it's incredibly risky. And for the Seed Enterprise Investment Scheme, you can invest up to £100,000 per year through the scheme into qualifying companies. And what you get is 50% of your invested amount can be used as relief on your income tax bill. And there are also some capital gains tax reliefs that you can get with the seed scheme. So if you had invested £100,000, you would be able to claim £50,000 in income tax relief, which you can use in the current tax year, or you can actually carry back one tax year. So it's flexible like that, which is kind of nice. It does mean you have to change your last year's filings, but to get 10, 20, 25, whatever it might be that you're claiming, it's worth doing. The other side of it is called loss relief for the seed enterprise investment scheme. So if you had invested 100,000, and let's say you put it into one company, which I wouldn't necessarily recommend, it'd be quite a risky strategy. But if that company went bust, liquidated, you would get additional loss relief on the £50,000 that you still had at risk. And what I mean by that is you invested 100, you get to claim 50 up front as income tax relief. So you still have 50 left, if you will, in the company. And on that £50,000, you're able to claim whatever your tax rate is, so 40, 45% in additional loss relief. So you're effectively only out for, depending upon your tax rate, you could only be out for about 15% of the investment, which is amazing. Well, 20% of the investment. So you've invested 100 and you're only at risk for about 20% of it. Kind of a nice incentive. You can't lose it all. With the EIS relief, which is what our fund is, it's still quite generous. It's not as generous as the SEIS relief, but instead of 50% upfront, you're getting 30% that you're able to claim off of your income tax bill, which is still nice. And you also have that additional loss relief that you can claim should the investments go to zero. So with EIS, you're out for about 30% of your investment in total if everything went wrong, which, it's 30%, but you haven't lost that 70%, which is kind of nice.
Yeah, that's really nice. You mentioned about, the risk that something can go wrong. And obviously when we are talking about startups, the risk is higher than a public listed company or an established business, for example. Can you maybe just talk us through the main risk associated with investing in startups?
Yeah, I think the biggest thing is the risk is you could lose it all. You could lose all of your investment, less the reliefs that you would get from it.
If the founder die.
Yeah, no. I think the outcome for most startups is that they fail. That's the truth for it. Or they don't return any money to investors. And unlike public market or publicly traded companies, there is no market where you can get out of these companies at any point that you want. Effectively, you're invested until that company lists on the market or gets acquired. Those are the two main kind of potential exits for an investor. And it's a very long-term investment, as I mentioned earlier. So if you're looking at a software company, the average time to exit is somewhere between 7 and 9 years, depending upon which source you quote. If you're looking at something that's in life science, biotech, medtech, pharma, it's more like 15 to 20 years. Wow. So when you invest in these companies, you have to be thinking in, say, decades, as opposed to months or days in which you want to get out of it. And that's the first thing to keep in mind. So there's this timeline risk, if you will. There's also just the risk that it's very early stage. It's unlikely that the company will actually go on to do something big. There's thousands of companies that start every year. Only a couple really return money to investors. And so your chances of getting into that one that becomes a unicorn in 3 years' time is highly unlikely. However, it is risky, but you're also, in a way, supporting the economy by investing in startups. Startups account for a large number of job creations. Startups account for a lot of innovation as well. So even if you've invested in a company that's working on, say, a medical device or not, and they develop IP, they might not necessarily monetize that IP, and maybe they go bust before they get to the monetize stage, but what they've developed might be picked up by someone else, and the IP that they created in the innovation might then let another company go on to be successful with that. So there's a lot more that goes into the funding of a startup than the potential monetary return. And I used to talk about okay, well, if you invest in Coca-Cola, right? Stable business, lots of sales, it might go up, it might go down some years. Over time, it does go up. You're not really, with your investment in Coca-Cola, you're not really creating jobs, you're not really creating, added value. But if you invested in a local say brewery, not that we've invested in any, you know, you're going to support them, you're going to help them create jobs, help deliver growth to the area around them, because then the money's going in and the money's going out and it's being spent more locally. So it's, I don't want to say it's a circular economy, but there's much more circularity to investing in startups than what you would get with investing in a conglomerate.
I think you brought up a very interesting point that sometimes actually people don't think, how you can actually support the, progress investing in early stage company rather than just in public market. And I think that is quite important. And it just kind of make me thinking about all these NFTs and crypto art, and it's kind of a way also for NFT, a way for artists to get supported by the community and get funded. So we see a similar pattern that is evolving also in the blockchain space, which is kind of interesting. So maybe we are going to see NFTs actually coming to the investment arena very soon.
Yeah, no, and when we look back on it, not that it's the only reason we do it, but on the last 12 months, the companies that we've invested in have created over 200 new jobs, which may not sound like a lot, but we're a small firm. And so it's kind of nice to think like, if you're a smaller investor, you're putting money into this company and it's helping create over 200 jobs, but also during the pandemic, you're ensuring that a lot of other jobs are kept safe and that the innovation continues, and that these companies don't go bust. We, in the last 12 months, unfortunately, did invest in one company that has gone bust, 1 out of 50, not a bad statistic, but it was a company called Hop Vietnamese, a chain in London. We invested in February, the start of February. March kicks on, they have to close all the shops. They couldn't switch on kind of the delivery quick enough, and they eventually had to close their doors, which was a shame, and there was some job loss there. But by and by, most of them are the companies we invested in are doing quite well. They've adapted, and they could adapt quickly because they're smaller and more agile to working from home, to the new environment. And whereas some of those kind of larger firms have really struggled to work in this environment that we're in now, and it's taken them much longer to do so. So I do think there's a lot to investing in startups beyond just potential financial returns, as you highlighted as well.
Do you have any favorite startup or company in your portfolio that you would like to talk about?
I don't have any favorites. I'm not allowed to say them. I've been impressed by a lot of them. So we invested in a company called Farm-Enable. The founder, her name's Hannah. She's just a force to be reckoned with. And when you speak to her, you're like, wow, blown away by how smart she is and how smart the team is. They're working on one of the companies that's using machine learning and AI for drugs discovery. In their first couple of years, they've already signed pretty large contracts now with like GSK and AstraZeneca. Don't quote me on that because I forget which one, but one of the very large drugs manufacturers, which is great. They're this small team of what was, I think, about 8 people, and they raised a good round to grow and deliver some really exciting things. That's one. Wild AI, is a Fintech company focused on performance of female athletes. The founder for that, Helen, she another force to be reckoned with. She does these ultra marathons, crazy things like that. And she often used Strava and other things. But what she found, she's a data scientist as well, what she found when she was looking through these was that all of the programs that were developed for old fitness apps are using data sets that are predominantly fueled by male athletes. And obviously recommendations for a female athlete and a male athlete need to be different, and for female athletes, taking into account your cycles. And this was something that, all the other stuff she did never took into account. So where she was getting advice when, she was at whatever stage of her cycle she was at, it was completely wrong because hormone levels have varied at this point in the cycle versus that point in the cycle. And what she just said was like, I'm just going to build this myself. If anything, I'm going to build this performance tracking and improving app for me to use and my friends to use. And obviously there's a huge market for it. About 50% of the population could benefit from it. And so that was really cool to see. I mean, the list goes on. We did 50 companies, so I could
Yeah.
talk about it for a whole hour if you really wanted to.
It was nice to hear something about fitness, and I think this diversity, between men and women performance is actually important, and I think this sector is actually getting more and more traction, and is going to get more and more tech integrated because
Absolutely.
Yeah, it's amazing. I'm using my Aura ring. Which
Nice.
I love it, and it helps me tracking my sleep and finding out if I get enough deep sleep, and it's kind of curious, but in a way makes you even if the data, let's say, they are not super accurate or you don't know much what you can do with them, it makes you actually thinking, right?
You're aware of it, yeah.
Yeah, exactly. I might need to get more exercise, walk more, and I think all these things, they help.
They do. I mean, if anything, to just highlight it to you how you're acting. It might not be the best advice for you what it says, but I've got a Fitbit, and it's like tracking steps and a few other things. Do you need 10,000 steps a day or 12,000 or whatever you set it at? Probably not, but there are some days when I look at it and it's halfway through the day and I'm like, oh, I've walked 800 steps today because I've been at my computer on meetings or doing emails. I should probably do something, so go out for a walk and just be active and go from there.
Okay, Tom, it was great to have you on the show, and that was a really interesting chat. So I hope to have you back soon.
Oh, it's a pleasure. Thank you very much for having me.
So this is everything from the Financial Fox. I hope you enjoy our episode. If you have any question, please do get in touch. Any feedback is always welcome, and I will see you next time.